The cost of capital is the heartbeat of financial decision-making, influencing investment choices, project assessments, and corporate finance strategies. The cost of capital refers to the expense a company incurs to finance its operations or investments through equity, debt, or a combination of both. It represents the rate of return that investors expect to receive on their investment in the company. It's the rate of return required to make a capital budgeting project, like constructing a new factory, worthwhile. Breaking down the cost of capital, we delve into its components: the cost of debt, the cost of equity, and the weighted average cost of capital, or WACC. The cost of equity is typically determined by the company's stock price performance and dividend payouts, reflecting the perceived riskiness of investing in the company's shares. On the other hand, the cost of debt is influenced by interest rates and the company's creditworthiness, with higher-risk borrowers facing higher borrowing costs. Additionally, the weighted average cost of capital, WACC, combines the cost of equity and the cost of debt, weighted by the proportion of each in the company's capital structure, providing a comprehensive measure of the company's overall cost of financing. Each plays a distinct role in a firm's financial health and strategic planning. The cost of debt is essentially the effective price a company pays on its borrowed funds. Understanding the cost of capital is crucial for businesses when making investment decisions and evaluating the profitability of potential projects or ventures. It's calculated by adding a credit spread to the risk-free rate of return and adjusting for taxes. This cost impacts a company's profitability and cash flow, making it a crucial factor in financial evaluations. Moving on to the cost of equity, it's the expected rate of return demanded by investors. It compensates for the risk of investing in the company and can be estimated using methods like the Capital Asset Pricing Model, or CAPM. The cost of equity reflects the market's charge for the privilege of asset ownership. The WACC represents the average rate a company expects to pay to finance its assets, weighted according to the proportion of each financing source in the overall capital structure. It's a blend of the cost of equity and the cost of debt, factoring in the tax rate, and it's used to evaluate the overall cost of financing the company's operations. Let's apply these concepts to a real-world scenario with ABC Limited. With a market value of equity at $100 million, debt at $50 million, and given rates for equity, debt, and taxes, we can calculate the cost of debt, equity, and ultimately the WACC. For ABC Limited, the credit spread is 3%, the cost of debt is 4.5%, and the cost of equity is 11.4%. With these figures, we find the WACC to be 8.725%. This number is pivotal for ABC Limited to decide if potential projects are financially viable. Understanding and applying the cost of capital is essential for high-quality academic projects in finance. At Essay Tips, we empower students with the knowledge to tackle complex finance assignments confidently. For those seeking professional assistance, our expertise is just a contact away, ensuring your academic success. In conclusion, whether it's the cost of debt, equity, or WACC, mastering these financial concepts can elevate your projects and decision-making to new heights. Essay Tips is here to guide you through every step, ensuring you not only understand, but can adeptly apply these critical financial principles.